Introduction to relative volume. Relative volume compares the current trading volume of a security to its past volume over a specific time period. Unlike absolute volume, which just counts the number of shares traded, relative volume provides context by comparing current volume to historical averages. Relative volume is a key indicator used by traders to identify unusual market activity. It helps identify unusual market activity and provides better context to raw volume numbers. This makes relative volume more meaningful for analysis and helps traders spot potential trading opportunities. By comparing current volume to historical averages, relative volume provides essential context that helps traders make more informed decisions. To calculate relative volume, we use a simple formula. We divide the current trading volume by the average volume over a specific time period. Let's look at an example calculation. If a stock typically trades 1 million shares daily on average, and today it's trading 2 million shares, the relative volume would be calculated as 2 million divided by 1 million, which equals 2.0. Let's visualize what this means. A relative volume of 2.0 means today's volume is twice the normal level. Most trading platforms and charting software calculate relative volume automatically, but understanding the formula helps interpret the values correctly. Relative volume can also be expressed as a percentage. A relative volume of 2.0 is equivalent to 200% of the average volume. Relative volume can be analyzed across different time frames to suit various trading strategies. The time frame you choose depends on your trading style and the patterns you're looking to identify. Intraday analysis compares the current hour to the same hour on previous days. This is useful for day traders and scalpers. Daily relative volume compares today's volume to the average daily volume over a specific look-back period, typically 20 or 50 days. Weekly comparisons help identify significant volume patterns that might indicate larger market shifts or sector rotations. Monthly relative volume analysis helps long-term investors identify major trends and potential market regime changes. Different types of traders focus on different time frames. Short-term traders typically analyze 5-minute or hourly relative volume to capture intraday momentum. Long-term investors, on the other hand, might analyze daily or weekly relative volume patterns to identify significant trends that develop over longer periods. The key is to align your relative volume time frame with your overall trading strategy and intended holding period. High relative volume occurs when trading activity exceeds 1.5 to 2 times the normal volume levels. A reading between 1 and 1.5 is considered normal trading volume. When relative volume crosses above 1.5, it signals unusually high activity in the market. Readings above 2.0 indicate extremely elevated volume, often associated with significant market events. This elevated activity reflects much higher participation from traders and investors compared to typical market conditions. High relative volume can signal several important market conditions. First, it often indicates breakouts where price moves beyond established support or resistance levels with strong conviction. Second, it can signal continuation of an existing trend, suggesting strong momentum in the current direction. Third, it frequently occurs as a reaction to news events, such as earnings announcements, economic data releases, or significant corporate developments. The relationship between price action and high volume provides crucial insights for traders. When high volume coincides with price increases, it indicates strong buying pressure, confirming bullish sentiment. Conversely, when high volume accompanies price decreases, it reveals significant selling pressure, validating bearish momentum. The timing of volume spikes within a trading session provides additional context for interpretation. High volume at market open often reflects reactions to overnight news and confirms gap movements. This can indicate strong directional bias for the session. Mid-session volume spikes typically signal intraday news events, increased institutional participation, or potential trend reversal points. Late-day high volume can indicate end-of-day positioning, short covering, or anticipation of the next trading day, often reflecting market expectations. To summarize what we've learned about high relative volume, readings above 1.5 to 2 times normal volume indicate significant market activity. This activity confirms breakouts, trend continuation, or news impact. Rising prices with high volume reveal strong buying pressure, while falling prices with high volume demonstrate strong selling pressure. And finally, the timing of volume spikes provides additional context for market interpretation. Low relative volume occurs when trading volume is significantly below the average historical level. This is typically defined as relative volume below zero point 0.5 or zero point 0.7. Low relative volume typically occurs in several market scenarios. First, during consolidation phases, when price moves sideways and market participants wait for clear direction. Second, during holiday periods when overall market participation is reduced. And third, before major announcements, when traders become cautious about taking new positions. When price movements occur with low relative volume, it suggests the move may lack conviction. Low volume has different interpretations depending on the current trend. During uptrends, decreasing relative volume might signal weakening momentum or buyer exhaustion. This can be a warning sign for a potential trend reversal. During downtrends, low volume could indicate diminishing selling pressure or seller exhaustion, potentially signaling a bottoming formation. Let's review the key points about interpreting low relative volume. Signals reduced market interest compared to normal, common during consolidation, holidays, and pre-announcements. Price movements with low volume often lack conviction, can indicate weakening momentum in uptrends, may signal diminishing selling pressure in downtrends. Volume at specific times of the trading day follows predictable patterns. A trading day has distinct volume patterns across different time periods. Opening hours, typically the first 30 minutes of trading, show higher volume as traders react to overnight news. Lunch hours typically experience lower trading volume as market activity slows down midday. The closing period, especially the last hour of trading, shows higher volume as traders position themselves for the next day. Analyzing relative volume helps identify unusual activity. For example, high volume during typically quiet periods might signal important developments. Understanding these volume patterns helps traders set expectations and identify potential trading opportunities when volume deviates from normal patterns. For example, high relative volume during midday might signal important developments that could affect price direction, such as unexpected news or earnings announcements. By analyzing volume at specific times of day, traders can gain valuable insights into market behavior and potential price movements. Relative volume becomes most powerful when analyzed alongside price movements. When trading, it's essential to look at both price movement and volume together, rather than in isolation. A price breakout with high relative volume has greater significance than one with low volume. High volume indicates stronger participation and conviction in the move. Notice how the high volume breakout provides a stronger confirmation signal, suggesting the price movement is more likely to continue. Similarly, a price reversal on high volume may indicate a stronger change in trend. The increased participation suggests a significant shift in market sentiment. Look for confirmation between price action and relative volume. They should tell the same story. When price increases with increasing volume, this confirms the uptrend strength. When both price and volume are increasing together, it provides a stronger confirmation of the existing trend. Divergences between price and volume can signal potential reversals or false breakouts. When price rises but volume decreases, the move may lack conviction. This can be a warning sign that the price movement lacks participation and may soon reverse or stall. Remember these key points when combining relative volume with price action. Price breakouts gain significance with higher volume. Price reversals with high volume indicate stronger trend changes. Look for confirmation between price and volume movements, and watch for divergences that may signal reversals or false breakouts. Several specialized tools are available to help traders visualize relative volume. The RVL indicator displays the volume ratio either numerically or as a histogram, allowing traders to quickly see how current volume compares to average volume. Volume by price shows distribution of trading volume at different price levels, revealing where most transactions occur. Higher volume bars indicate price levels with significant trading interest. Volume profile reveals where most trading activity occurred over time, creating a three-dimensional view of price and volume. The point of control shows the price level with the highest trading volume. Heat maps display relative volume across multiple securities and time periods. This visualization makes it easy to spot unusual trading activity across an entire market or sector. Most modern trading platforms offer these relative volume tools, allowing traders to quickly identify unusual volume patterns without manual calculations. These integrated tools provide real-time analysis for informed trading decisions. Let's explore practical ways to apply relative volume in trading strategies. First, you can set alerts when volume exceeds specific thresholds compared to average volume. This helps identify unusual activity that may lead to significant price movements. Pre-market volume can be especially useful for predicting which stocks might be active during the day. Volume is crucial for confirming breakouts. A price breakout should be accompanied by higher than average volume to validate the move. Breakouts on low volume have a higher probability of failure, so waiting for volume confirmation can improve your entry accuracy. Volume spikes at resistance levels can signal potential reversals. Watch for price approaches to resistance with unusually high volume. Similarly, diminishing volume during price rallies may indicate weakening momentum and a possible reversal. Different trading timeframes benefit from volume analysis in unique ways. Day traders can use morning relative volume to identify which stocks might trend during the session, while position traders might look at weekly volume patterns to confirm emerging trends. Volume analysis is most effective when combined with other technical indicators and chart patterns. This integrated approach helps filter out false signals and provides a more complete picture of market conditions.